Hey fellow investors and fellow stock guardians, it's Friday, February 5th, 2021. I'm Hoda, co-founder and CEO of StockGuard, reporting to you from a barely green stock market. The stock market indices did what they do best, fluctuating all day, and at the end of the day, all three wrapped Friday in the green but only barely. The new $1.9 trillion COVID-19 relief package by President Biden was approved today, and that was one of the main reasons the stock market closed the week in the green. Today, on the winners list, I noticed Zoom. Shares of Zoom Video Communications jumped more than 7%. I own a few shares that I picked up after the price drop in the last few months, so I'm a happy camper today. The all-popular video conferencing platform had lost some of its 2020 momentum since October, mainly due to two reasons. One, already a very high valuation, and two, issuing new shares through a secondary public offering. Today, there wasn't any specific operational news from the company. The price jump seems to be due to an unusual increase in options contract volume, and the options contract volume unusual activity seems to be in response to the launch of the Zoom Room services that was announced this week. Zoom is getting ready for its customers going back to their office buildings, and the new Zoom Room service is designed to support the transition back to the office. For example, it allows users to virtually check in an actual office building without visiting the receptionist or join a video conference from their own devices, even though they are physically present in the same room or in the same conference building. So that's a good opportunity for Zoom to stay relevant, even though its users continue to go back to their usual life. On the losers list, I noticed New Relic. Shares of New Relic were down more than 16%. The company is among the technology infrastructure high flyer stocks that benefited from the world's transition to digital life. However, in its latest quarterly earnings report, it spooked investors with a significant jump in its operating expenses and a small revenue growth outlook. The problem is that this IT infrastructure performance monitoring and analytics provider is transitioning from a subscription-based model to a usage-based or pay-as-you-go model. In this new revenue model, customers pay for what they use, and it messes up the growth rate comparison between this year and the previous year. I was wondering if the price decline is an opportunity to buy a few shares, and I took some time to read the shareholder letter that was published with the quarterly earnings report. At the first glance, it seems the transition from a subscription-based model to a consumption-based model means a shift in when the company can recognize its revenue. Let's not get too technical, but in simple words, the revenue model shift can justify why the expected revenue growth rate for the next quarter is only 4%. New Relic goes to my watch list. The transition would still take a few quarters, and that may give us enough time to monitor and confirm that the company is still growing rapidly and the new revenue model transition pans out as the management has argued in its latest shareholder letter. I have something interesting to wrap today's episode. At StockGuard, we organize a coffee and learn session every Friday. We use these sessions to learn something new as a team, and this week we focused on the role of short sellers in the stock market. After the GameStop short squeeze drama, several investors have called for the death of short sellers. Members of our own community on Facebook, the Intelligent Stock Market Investors Facebook group, discussed this topic in details. Those conversations inspired the team and me to explore the topic. The result was quite interesting to say the least. The most important reason for short sellers' existence is to hear the counter argument to a buy recommendation. For example, if you believe Tesla is a rocket ship that everyone should invest in, short sellers can bring the counter argument to help you balance your perspective. Good investors would always want to hear the counter argument to their research and due diligence, and short sellers are the best source of such counter arguments. The second reason why short sellers are good for the market is that their arguments create opportunities for investing in stocks we believe in at an excellent price. Take Tesla's example again. When short sellers bashed the stock and shorted the company's stock heavily, it gave investors such as the almighty ARK Invest to pick up shares at a much better price. In the end, yes, short sellers are annoying and create drama such as what we have observed happening for GME's stock, but they also create counter arguments and buying opportunities that many investors could not have access to in a world where no short seller is around. As we wrap this week, we are sending love to short sellers out there, even though they have created so much drama and pain for many investors, especially retail investors in the recent weeks and months. As always, if you like to give a StockCard VIP a try to research as many stocks as you want and follow successful investors' portfolios, use promo code ROLLWITHOURCEO, all lowercase and in one word. That's it for today. If you like these quick market recap reports directly from my daily stock market research, please like and subscribe and share with your fellow investors. I'll see you next week.